everyone. This is Darius Dale to present our macro bundle Q&A for Wednesday, December 8th, 2021. I'm joined by my good friend Andreas Himmelreich of Germany's sophisticated retail investor extraordinaire. How you doing, Andreas?
Very good. Thank you for having me.
No, it's a pleasure, man. Thank you for coming on. Just give you a little bit of background about yourself. Andreas has put together a presentation to sort of walk through how he incorporates our signals into his own investment process. Hopefully, those of you who are out there sort of kind of looking for ways in which to further augment your process with what we're producing here at 42 Macro, you can take some insights from Andreas, some pitfalls, some do's, don'ts, and all that good stuff. So without further ado, let me just toss it over to Andreas.
Thank you, Darius. How I use macro 42 coin as a retail trader with a sub 1 million account. That's my background. Got a degree in economics. Then went on the street and as a consultant. And then I went into IT management. In between, I wrote a dissertation about software-based trading systems. I'll show a trading system that I've designed within that dissertation. I was a part-time systematic retail trader since 2011. Printed 25% performance per year after tax since then. So nothing spectacular, but okay. Um, okay. And I 2020 I said, okay, that's it. I don't want to be in IT anymore. I want to basically trade my own account. And since then, I'm a full-time. Somehow, it's a mixture, discretionary to systematic trader since 2020. And for tax reasons, I have to basically incorporate the name of the firm will be Quantstrike. And maybe I don't know where the road goes. Maybe in a couple of years, I might raise some money. Let's see. But I still need a lot of experience and want to be good at the game in before I do that. Okay. So I think the best Market Wizards book is clearly this one. It's also the newest one. Because it's basically about traders that really start small with a small account and with whatever sub 1 million account, sub $200,000 account, and those market wizards really show what you can do with that small account. So the lower the amount of the account, whatever 100K, 200K, the higher your performance can be, and because you can trade, thinly traded stuff, small caps, and you can be in and out of the market pretty fast. So not like the bigger guys. And I think Darius, you just stated that hedge funds used to do that because they were small enough to really, get a lot of performance. And there are still small hedge funds who have that flexibility. Yeah. Okay. So when I read the book, first of all, I was really inspired. I didn't know that this is possible, that those numbers they were printing, I don't know, 50, 60, 70% year after year, for a very long time, 10 years, something like that. And what do they have in common? First of all, smaller account size. I already talked about that. So they can really have big performance, and they can read the market regime and apply strategies that fit to it. So, 1996, I read the book How to Make Money in Stocks from William O'Neill, the CanSlim strategy, and the real successful CanSlim traders. I have, some of them in my network who printed 200% last year, or 300% last year, 200% this year, and they just took that canceling strategy, which kind of it's a breakout strategy with fundamentals on it, and they just pressed it hard in the reflation regime we had, and that's kind of really what they're doing. But they're out of the market in no time, in absolutely no time. When the regime is not good, they're out. They're sitting in cash. So um, that's kind of the art, to know where we are, where's the regime, and then having a strategy that fits to the regime. And then if it all lines up, to press and if it does not, to be really conservative. Okay, so yeah,
risk in all market environments.
no,
There are times to be a pig. I would argue, we were as piggy as it gets going back to November of 2020 and December of 2020. But November of 2021 and December of 2021 are very different market environments. You probably
exactly,
shouldn't have as much capital at risk, certainly to the extent if you've had a decent year, as we know we've had for the most part.
exactly, yeah. And so, I my stage as a system trader from 2011 on. I tried to create a trading system for all market regimes, and don't try it. It doesn't work. I put in years of work into it. I don't think that's possible. So if you have one trading system for all market regimes, you might do well, but you're going to experience very big drawdowns. And usually, if you have a really big drawdown, you start to make mistakes, and then you should stay in the regime, but a lot of people don't. So that's my personal capital curve here. And as you see in March 2020, that was the max drawdown. And I just want to show you with what kind of trading systems um, I reached my whatever 25% after tax return. That is one of my oldest systems, and it's also one of my not so good systems. So that was just the beginning, and so it's a small cap trading system, rebalances every three months. You basically, if you look at it right now, you can see the stages of the market pretty fast. So, and I will make that point in a minute. That's a trading system I designed within the dissertation. Obviously, my professor said, "Okay, that's nice, but you're just trading high beta." And he was right, as you can see, as you can see on the chart. Yeah, and yeah, I didn't have an argument against that. But now the point comes: if you have one system, one trading, it doesn't matter. It doesn't have to be portfolio 1 2 3 system. It could be Canslim. It could be Qualmagi kind of breakout trading, and you do a macro42.com overlay. Then a whole new world opens up. That's the same system I just showed you, and I follow Darius since basically 2016, and the arrows you can see are basically the general direction of the market. What Darius thought, beginning of 2016 was pretty bullish. 2017 was pretty bullish, and then in for the fourth quarter 2018 there was the big um, that was deflation. That was a big deflation warning, and pretty spot on. I mean, it was almost unbelievable. I didn't follow the call, I have to say, because I was, I don't know, I didn't. I should have. And a month later, 2 months later, I had a drawdown of 30%, and I said, "Oh, guys, this stuff is working. Darius is right." And then, yeah, well, yeah, but then the call was, I think the call was inflation.
Yeah.
Call was inflation, and then basically, I think it was in the aftermath. It was even Goldilocks, but you
Mm-hmm.
know, not as bad as a continuing deflationary market. And yeah, then from what I remember, 2019 was, you guys were still like in long duration stuff. You were pretty conservative, and I think I think you Darius said then basically the fourth quarter of 2019 it was cautiously bullish, but then in February the big warning came, and then okay, COVID came and nobody could have foreseen that, but still the call was right. And then the next call I remember was in somewhere around June 2020, 2020, and then Darius, your big call, which was spot on in November last year, and just look at the arrows and take a decent trading system, and then listen to the calls and reduce whatever to cash or go to long duration TLT, something like that. So that's the point here, basically.
Not going to get them
Okay.
all right. That's for sure. Hopefully, knock on wood, the process is expressly designed to help avoid drawdowns. We're not going
Yeah.
to nail every we're not going to have the highest upside capture ratio. Certainly, whenever we're in an inflation or deflation regime, that's not the goal. The goal is, as Andreas mentioned, is to protect and preserve capital. So, hopefully, we're
Yeah.
doing our job on that.
Yeah. Exactly. So third stage is basically an all-weather dynamic book that does well in Goldilocks reflation, inflation, and shallow deflation with a 42 macro overlay. Um, the thing is, I don't like that really because you're not really specialized to one regime, and it looks really nice, but it only has, like, as I said, with a small account, 34% on all the regimes we had, that would be not enough for me. So the next stage is, and the, I'm kind of in the beginning of that stage, as having systems that are specifically designed for the grid market regime and play, and the system needs a green line from the market regime, basically. So first experiences is it that it's really difficult to design trading system for inflation and deflation, really difficult. So I'm kind of, just thinking, well, why don't you go just really conservative and in deflation and inflation, and press the button in the other two bullish regimes. But so I'm kind of still in the finding phase here. Okay. Um, when I show that system, I get a lot of pushback because, obviously, and I can understand that people say that's not possible. You can't have 80% performance, and it's true, you can't, but you can if you have a small account. So this is, trades tiny, small caps, micro caps with good earnings revisions. It is totally concentrated. It has swings of whatever 10% every month. So it's pretty. You can't see it in the capital curve because it's not logarithmic, but it has pretty wide swings, and it's highly concentrated. It's on reflation and Goldilocks, and you need a really small account size. That's kind of one of my main points. If you have a small account size and then are able to time the market regime, and you're then in whatever in Goldilocks and reflation, you can really press it. And I got people in the network who made really, really good performance last year, this year. Yeah. Okay. And that's the same trading system with by calendar year. And there you see it. I mean, 2013 was, I looked at the data, was pretty bullish, was Goldilocks and reflation. 2017, 2020, at least from June on, November on, and then 2021 just, was, I think, the perfect year for that kind of strategies. Yeah. Mm-hmm. Okay. And another thing I wanted to say is that you don't have to go to portfolio 1, 2, 3. If you're interested in systematic trading, I think that's real good. Real good firm to use. They have great data, and it's, compared to other quant platforms, pretty easy to use. But a very, very good strategy would be just to use Cancelim, for example, as with a small account from Investors Business Daily, William O'Neill stuff. And here I have one trader. I don't know whether I can call him retail trader. I think he has over 70 million now. And what? Yeah, and I mean, just look at his Twitch streaming, and he is a very good tape reader. He is a very, very good tape reader, and As I said, if you have that kind of breakout strategies, you need to be in the right tape. Yeah. Okay.
Mm-hmm.
Do we have questions in the queue or?
Oh, we have questions in the queue, but I know you had some questions for me that you wanted to
Yeah. Yeah.
shoot
Okay.
over to the
Great.
audience.
Yeah. So we talked about it just before we were shooting that stream here, and I'm totally fascinated by that table because from how I understand it, if you don't have a lot of time reading through the whole report from you, Darius, that sums it up, right?
Mm-hmm. Yeah, I mean, look, this table is designed to impute everything we think, or not we think, but the models think are likely to happen with respect to growth, inflation, and policy into a sort of, kind of summarized, or one clear takeaway as it relates to the expected dispersion within asset markets. And so, in terms of reading this table, the first column, the macro regime column, that's the back test for the broad, for that broad regime. So, with respect to the trailing 25 years, what's the annualized monthly return of the asset of the particular exposure whenever we're in this regime in the economy? And so again, these are trailing 25 years of observations. Moving, kind of left to right, the growth delta, that Z score is effectively, okay, what's the back test? So if I think growth's, going to move in the direction that's indicated by the regime, so obviously in inflation, growth slowing, is the delta that the model is projecting on the 3 to 6 month forward basis? Is this something that is very, large? It's a small, medium, or large, and so small would be obviously indicated as a 0 sigma delta, and as the sigmas in relation to the trailing 36 month sample, trailing 3 year sample. A moderate delta would be a 1 sigma delta. So if you look over to the inflation column, we're calling for inflation to be continue to accelerating modestly on a trending basis, with respect to the inflation regime that the model is currently projecting through December. And so a 2 sigma delta would obviously be a more rapid advance or decline in the direction implied by the regime, the macro regime. And so policy rate, the back test for policy rate can include, obviously tightening, hiking, or cutting the interest rate. Policy balance sheet would clearly, be the Fed expanding or contracting its balance sheet. Fiscal policy is the deficit to GDP widening or narrowing. And then lastly, what's the rest of the world doing in the context of the U.S. back test? So inflation as well. And so we blend that all together in that blended return column. And we're doing that again in terms of the scatter plots. We're doing the same process again of pulling in all these sub back tests across, percent positive ratios, annualized expected returns, percent positive ratios, volatility, and covariance. The first two are on the y-axis of the scatter plots, the latter two are on the x-axis. And what those scatter plots are designed to do is take everything we think is likely to happen from a growth and inflation policy perspective, including the speed of the change in growth and inflation, the direction of travel with respect to policy, and help you visualize the kind of, sort of relative risk and returns that should coincide with all those dynamics being priced into the market.
Yeah, and I mean, I was really fascinated by your inflation call because first of all, if you look at the Russell 2000 index here, it has a planned annualized expected return from minus 8.1,
Mm-hmm.
and after the call, that just happened.
Yeah.
The Russell just lost, I don't know, I think from peak to draw, I think it was like intraday low was like 12%, something like that.
Mm-hmm.
And I think from your call on pretty much, I don't know, 6, 7, 8%, something like that.
Yeah,
And
and I think
yeah,
one thing I'll say is that it's one thing that's been really both, I would say, not frustrating, but it's been very challenging to communicate in the second half of 2021, because the
yes,
reality is we just haven't had these very clean, consistent trending market regimes, right? It's been grid zero, it's been messy, it's been very difficult. We haven't really seen a tremendous amount of trending sector and style factor leadership in either the equity or fixed income markets. And so, it's put more onus on the market signaling aspects of the process relative to the sort of economic aspects of the kind of metric
yes,
aspects of the process.
yes,
So when you're just at the beginning of a multi-quarter advance in reflation or something like that, you just set it and forget it. This is
yeah.
not 2H21 was not a set it and forget it time.
Yeah, absolutely. So I have one question for that table. So what's the weighting of the basically? Do you weight the bottom up and the top down regime into one regime, or is it just the bottom up regime here?
Yeah, no, so that's a great question. So, what we're doing in these back tests is effectively what we're trying to do. If you go to those, sort of, I think it starts on slide 35 in the most recent macro scouting report that was out yesterday.
Mhm.
Sorry, slide 36. So the scatter plots, where it's at the chart on the right represents the current regime, what the current market regime is, and I assume the current market regime is a function of everything we programmed into this table that we're displaying on the screen.
Okay.
The reason inflation is the dominant market regime, I would argue, is because all of these things are effectively happening economically. The chart on the right in those scatter plots is okay. This is how I think the market regime is going to evolve over the near to medium term. It could be 1 month, could be 6 months, but in terms of the distance, but we just think this is the next market regime. This is the next set of variables that the market is going to try to price in on a trending basis. So that's why we display that. It doesn't necessarily mean I think inflation is going to transition to deflation tomorrow, although we got a question, really good question there we'll address in a second. But so that's what this process is designed to do, is say, hey, look, this is the current weather. This is how the weather might evolve based on everything we think we know about the economy and policy.
Mhm. But as I said, I mean, I was the moment basically when you called for the inflation regime, everything changed. I mean, I look at the market pretty much, I don't know, 4 to 5 hours intraday, and
Mm-hmm.
every correlation I saw the whole year just went away. High beta was, I
Yeah.
mean, those high beta names, they were just crushed. They were really crushed. Russell 2000 was crushed, and there was almost no correlation anymore from the Russell to the cubes or to the spies. It was pretty severe. Yeah, it was tough, and it took me a little while to pivot, but I took down risk materially, and now I'm trying to design a system for inflation. It's a long short book. Long is on the Nasdaq 100 stocks. Picks good fundamentals and earnings estimates, and a short book on stocks that have over 100 billion market capitalization, are not a member of the S&P 500, and have bad earnings estimates. And let's see how that works in inflation. I looked at the table and said, okay, what's the what's the best exposure I can have where I have a system, and that was basically Nasdaq 100 stock index. So it's not the best, but there I have a system. And then I looked at high beta. I'm not sure if it's in here. Do I see it here? I think it was in the monthly scouting report. It has a 1 as a dynamic macro regime ranking. So I thought, okay, I'm gonna be long that one, which is okay, and it's gonna be short, which is really bad.
That's sort of so the point of the scatter plots too is to not sort of help investors remove their anchoring on returns. I mean, you can get the same return but expose yourself to a lot more risk by kind of investing in the wrong security. And so what those scatter plots are designed to do is help investors visualize really quickly, like, hey, if I'm for example, if you go to slide 36 in the scouting report, for all those of you following along, you look at something like the Qs, it basically has the same return profile as healthcare or slow beta and inflation,
Yeah,
but
yeah.
you're taking a lot more risk to generate that same return profile. And so it's not say you need to be short the Qs relative to the low beta or healthcare. It's just that if you're going to pick one, you want to be isolating yourself to the left side of the charts from a risk perspective.
Yeah, yeah. I thought that too, and I was trying to design a healthcare trading system, but no good so far.
Gotcha.
Yeah, exactly. Yeah. And then
Well,
I have another question.
mhm.
And I saw it actually in your monthly report, and because you have that table on the monthly report for deflation, and what I saw there was that the Russell 2000 is not doing that bad anymore. I
Mhm.
think it's on, I don't know. And what really puzzles me, that when I look at my trading system, that are kind of micro caps, they don't do very bad in a deflationary regime, at least if there is no volatility event. and low volume, low trading volume, low value momentum quality small caps seem to perform pretty well. Can you confirm? Because that
Yeah,
was kind of
absolutely.
a head scratcher.
Absolutely. So the annualized expected return. So looking at the Russell 2000 back test, the annualized expected return in deflation on an aggregate basis in terms of the overall back test, the full sample is minus 5% annualized return. When you're
Ooh,
talking
okay.
about a zero sigma delta slowdown, so a very modest slowdown into deflation from a growth perspective,
Okay.
the annualized return is a plus 14%. When you're talking about a moderate slowdown, so as a minus one sigma delta, the annualized return is still positive, but it drops to plus 9%. Guess what the delta is on it when it's minus two sigma? It goes from plus 9 in a minus 1 sigma back test to a minus 29 in a minus 2 sigma back test. So that right there
Okay.
just tells you that the speed of the change in growth and the speed of the change in inflation, which has a very similar impact on the back test for the Russell 2000, really do matter. You need to get not only the direction right, but you need to also get the magnitude right, and secondarily you need to get the policy response right as well.
Well, but that also tells me maybe not to trade small caps in a deflation regime, because if you're off a little bit on your growth projections, your outcomes could be very different, right? So
Yesterday. I
yeah,
said
yeah,
yesterday, look, the balance of risk is very asymmetrically skewed to the downside in growth next year. The growth expectation out there for Bloomberg consensus is still somewhere around 3.94%. The US does not grow 4%. We are a 2.25% economy as it relates to productivity and wage growth and kind of how we've been tracking on that. And so in order for us to grow an additional 175 basis points, we effectively have to, kind of make up stories about, kind of the was it consumer balance sheet being healthy and pent up demand for services. And I agree with all those things. It's just that they better happen, because if they don't happen, we're going to
yeah,
have an absolute collapse in growth expectations. And that to me is the big issue as it relates to already, kind of having growth in inflation decelerating on a trending basis throughout most of next year. The problem when you start to decelerate and you decelerate persistently, if anything happens from a market volatility perspective or a real growth shock, the terminal downside of growth expectations is unknown. And then to me, that's a real big issue.
yeah. So that's kind of what I figured too. Also the outlook. The outlook looked pretty shallow, so we might get a shallow deflation or whatever. But if anything happens, the market would be very vulnerable, and don't. So my take is don't take the risk and bet on it. That's shallow. At least not, I don't know. At least not at that stage of the market, because we had a real good run, and then just stay conservative and really only play the stuff that back tests very well in a shallow and in a deep deflation and inflation regime. Yeah,
You spot on. And I think you just said something about investor psychology that I think it's important to
yeah,
re-highlight as well, which is the quote, "We've had a good year." I mean, a lot of folks have had good years, and a lot of folks aren't going to want to give back a lot of performance. Not just into year end, because it's not just a calendar, but it's also going to be, looking out. When you look backwards, you're going to see three, massive double digit returns in the stock market. Looking at 2019, 2020, 2021, and I don't think there's going to be a lot of willingness for investors to sort of say, hey, if things really start to come unglued, right? We've been buying dips at the 5% mark or the 50-day moving average for the S&P 500 for over a year now.
yeah,
If that process breaks, it's going to break hard,
yeah,
because there's not going to be anybody there left to say, okay, it's 5 now, let me buy it at 8. Now, I think the next bid is at down 15 or 20. And that to me is the big risk, because there's a lot of P&L kind of cushion out there that people are going to want to protect
yeah,
if the
yeah,
move swings.
yeah. No, I mean, I have that fight in myself too.
Yeah.
Should I take more risk, or should I take risk down? And I have a lot of friends, and I tell them, look, get more defensive, and take down risk. And they ask me every day, do you think that the bull market is over? And I tell them every day, yeah, that bull market you know now for, I don't know, since March or April 2020. that is definitely over. It's a different market now. We might get a little bit, it might be a small bull market, however you can call that, but it's definitely a different market, and you have to be manage risk, and then you basically talk to friends, and then they tell you, okay, how do you explain the rally of yesterday? I don't know.
Now try doing that with thousands of people on a daily basis.
Okay.
No, I'm joking. It's a labor of love. Transition. Let me transition to some of the questions in the queue here, if you
Sure.
don't mind. So we got first question from our buddy Mitch, who'll be joining us in a few weeks, I believe. I said, "What's happening, Team 42?" Says, "Saw you added Brazil and China this morning. Is it time to allocate to China, or should asset allocators be a little bit more patient?" So obviously implied by us adding it, we do believe that it's time to maybe step in and buy the dip, or not even buy the dip. The one thing, KBA actually sort of made a new high amid all the recent market volatility. So maybe that's a signal from the market itself saying, "Hey, look, the market is adequately priced in a lot of the the reform initiatives that have really catalyzed severe underperformance in Chinese assets all in the recent months." And so we certainly thought that was a good opportunity. I mean, you look at what slide was that? 113 or not 113? Sorry, 116 in the macro scouting report yesterday. You look at Brazil and China, and to me, I thought this was really interesting. This is something we called out in real time going back a couple of weeks ago, which is, hey, look, the dollar's going down in during this sort of all this market volatility. Now, that's not to say you got to run out of buy EM as a function of that. The unwind of those kind of like Japanese yen, Swiss franc, euro funded carry trades into U.S. equities and U.S. credit, but it may be a signal that the U.S. exceptionalism trade that kind of really catalyzed dollar strength, strengthen the S&P, strengthen the Nasdaq, strengthen our credit market, all-time lows in yields on both a nominal real basis and high yield. All that strength was a function of U.S. exceptionalism and our ability to outgrow the rest of the world, out vaccine the rest of the world, and in a day kind of outstanding the rest of the world. And to the extent that that's coming unglued at the margins, you're going to want to start to look elsewhere for those types of opportunities. So the fact that Brazil and China didn't budge amid all the volatility, to me, is a signal that a lot of the negativity in both of these markets has been priced in. And eventually, we're at least in Brazil, we're on the precipice of transitioning to Goldilocks economically. China, that transition should start to occur kind of in the mid to late Q1. All right, so next question, Rich is asking, good morning, Rich. So from this morning's leadoff morning note, could you please clarify the comment? Inflation's current share is now tied with its trailing 3-year peak. It's either deflation from here or bounce to lower highs and Goldilocks and reflation. So, kind of looking at slide 26 and slide 26 in the deck, where we show our share of confirming market regimes analysis within the context of the global macro risk matrix. What we're saying, hey, look, inflation, it's at its sort of trailing 3-year peak. It's not to say it can't go higher. Obviously, the peak will be what it be. The peak will be what it will be. But the reality is, it's probably not going to go much higher from here. And so the next, you have to start to anticipate a peaking in the impulse of inflation from a market regime perspective. And what that ultimately means is we're going to transition either to deflation, or we'll start to see that inflation curve. Actually, can I share my screen? Nope, never mind. Don't worry about it. I'll continue kind of walking through the chart, but we'll see a peak. We'll see a peak in that inflation curve, the red line on that chart, and what we'll start to see if the market can hang in there, we'll start to see the green line, this Goldilocks line, the reflation line, kind of bottom and start to make their way higher. I don't think we're going to transition to a Goldilocks or reflation regime because, again, we don't see an economic scenario that supports transitioning to a Goldilocks or a reflation regime, but that doesn't mean that the share of confirming markets can't move favorably in their direction and ultimately favorably for broader risk markets. So that's something to call out. So we were saying, hey, we're kind of at a crossroads here. But again, going back to the CACRI analysis we put in the morning note yesterday, and then also reshared in the Sky report on yesterday afternoon, the back test on entering the danger zone in CACRI, we show that on slide 28, is actually quite favorable. I mean, we go back and we looked at there's been 7 times CACRI's in it. Sorry, not the danger zone. My apologies. The consensus fear zone since the start of 2015, and the median return on pretty much everything risk is positive. Somewhere with the 60 to 70% percent positive ratio on a 1 month forward basis. And so this is it's a positive signal, and I certainly want to anchor on that in terms of not overly raising cash or kind of running and heading for the exits, which is one of the reasons we did add a little bit more risk on the EM side. EM is one of the best back tests behind crypto in terms of that Capri consensus fear signal. But again, we're not anchoring one specific component of the process. We're tying it all together. It's Capri. It's observing the current market, the action in the currency market. It's obviously the grid, the sort of grid outlook for both Brazil and China, diverging from the grid outlook in the U.S. and a lot of the developed world in the early part of next year. Another question here, Jimmy's called. Hey, Jimmy. Says you called out implied volatility discounts in equities post the short squeeze, but you flavored the comment with a warning. Very much did so. Said with elevated realized volatility, especially after the upside R vol. Don't you think the implied vol market is telling us that the move is over? Seems like a waste of capital to try to fade that. Yeah, definitely could be a waste of capital to try to fade that. I'm cognizant of the catalyst that we have ahead of OPEX. I mean, you're talking about a CPI report where you could potentially see a 7 handle on CPI, and then ultimately you have a Fed FOMC meeting next week where the Fed has to make a real about face. I mean, it kind of started to in Powell's testimony a couple weeks ago, but the reality is they haven't really fully acknowledged and pivoted towards, okay, we need to accelerate the taper. We need to put ourselves on a path to tightening the policy rate. Clearly, a lot of that's priced into the Eurodollar curve. It actually hit a new high today in terms of the number of hikes that are priced in. That's at where we at 86 basis points as of this morning. But that 86 could be be bid at 100, or like that's kind of the point here. It's like we don't know how asset markets are set up to respond from here, from this particular point forward, with respect to policy tightening, because again, the markets can do just fine in policy tightening when they think the growth outlook is improving. So either in Goldilocks or inflation. When markets think the growth outlook is deteriorating, that's when you start to bring on additional volatility in terms of investors not being adequately positioned for the removal of the punch bowl, as we talked about on Saturday. Robert's asking, you discussed in the scouting report that deflationary pressures were the reasons for the success of the 60/40 portfolio. Certainly disinflation was, in my opinion, the catalyst for that. Can you expand more on why this portfolio may not perform in the future with higher inflation rates? So I'm very much in the camp that 60/40 is not dead. Very much in the camp that risk parity is not dead. One thing we show in the scouting report from yesterday is the sort of on slide 83, we show the correlation between stocks and bonds, pulling the data back as far as we can go. So the blue line in that chart on slide 83, it shows the trailing 2-year correlation between the long bond futures and the Dow Jones Industrial Average. And, basically from the 70s all the way through the late 90s, that was a positive correlation on balance to the tune of an average of 0.4% or 0.39 in terms of the R on that. The inflation averaged about 5%, just about thereabout that entire period. And so, and part of the reason we saw that the big decline in the correlation all the way to kind of a persistently negative, kind of minus 0.3 to minus 0.4 correlation between stocks and bonds was a function of the disinflation we saw throughout the 90s and ultimately kind of all the way through the late 2010s. And so right now we're, going back to our sector inflation model that we did a lot of work on. That's on slide 66. The summary of that is on slide 66. In terms of our math on all the different drivers of inflation from a structural perspective, so not just cyclical, what drives inflation cyclically are things like changes in commodity prices, changes in terms of trade, changes in labor on a kind of a medium term lag. But from a longer term perspective, things like automation, demographics, fiscal policy, monetary policy, money supply, the wealth effect, all these things that are kind of longer term, have longer lead times with respect to influencing inflation. Our math is suggesting that the stationary mean of CPI has already transposed itself 60 to 100 basis points higher. So relative to where we were in the 2010s decade. So we're talking about in 2010, inflation averaged about 1.8%. Where it's likely to average, according to this model, according to all the dynamics in the model that we present on slide 67 and in the subsequent slides, we're talking about inflation average somewhere around 2.4 to 2.8% in the 2020s. That is not enough inflation from our perspective. Again, going back to that stock bond correlation analysis to break down that inverse correlation. I think you're going to have to do a lot higher than 2.5 to 3% inflation to kind of ruin that. So great question there, Rob. Appreciate you. Alvaro is asking, referring to slide 84 of yesterday's MSR, have you looking at using gold as perhaps a partial substitute for long-term bonds in a 60/40 portfolio? I've seen some analysis indicating that it works better. Certainly, that is, yeah, for sure, without question, gold will work better because it obviously has a higher beta than most bonds. But the reality is, if bonds stop working in the 60/40 portfolio, it's probably maybe not gold that you want to replace the 40 with. You probably want to have a little bit more gold on the 60 side and probably up in that 70 side, up in that to maybe 70 as well. I mean, don't forget cash is an instrument. Gold is obviously an instrument. The reality is, I don't think we need to make all these decisions today. I mean, who among us is investing, putting on trades for the next 10 years? I mean, I certainly don't think anybody would be tuned into minute 40 of a weekly macro bundle Q&A to talk about, a trade that, they're going to have on for the next 10 years. That's not what we're doing here. What we're doing here is making sure your portfolio survives the next 10 years, not your trades in the portfolio. That's the whole goal of macro risk management, is to make sure you don't suffer drawdowns at various critical junctures in the cycle. It's the growth cycle, the inflation cycle, the policy cycle, the positioning cycle. All these cycles really matter, and sometimes they align themselves in a way that can be very, very adverse to your financial health. And that's exactly what we're trying to do. So I think these questions are very valuable. I certainly have spent a lot of my time having these conversations with institutional investors. And thank you for those of you who are institutional investors for joining us today. But the reality is, that's not what we're trying to do. We're trying to actually help you manage risk around the cyclical components of it all, so that, when you look back 10 years from now and say, okay, how did my portfolio do? It won't be a function of the trade you put on today. It'll be a function of the risk management decisions you made throughout the entire process. So next question. Oh, this is a great question. I love this question. Got this a bunch. Himmler's asking, how come inflation backtests are awful for energy? Well, that's because backtests for high beta and high beta, leverage, value, all those types of style factors are negative in stagflation, or in whenever growth is decelerating or inflation is decelerating. So that's a the critical component. Certainly when you look at when you study the returns, and again, these are monthly returns on a trailing 25-year basis, and so the percent positive ratios are really low for energy as a sector when you're in stagflation, or inflation as we call it. Obviously, clearly for deflation as well. And so that's the market telling you that, hey, look, even though the price of crude oil is going up, I'm not going to, sort of allocate to this exposure, because I don't believe in the sustainability of that price, because clearly demand is slowing as a function of the growth outlook. Let's get a couple more before we wrap up. Rich is asking, oh, sorry. Sorry. For your GDP forecast, could you indicate a level that would equate to -1 sigma and -2 sigma? So in terms of the OECD composite leading index data, I actually just updated that the other day. It's actually it's just shy of 1, so 0.9 for a -1 sigma change, and then it's just it's 1.7 for a -1.7 for a -2 sigma change. So you're talking about some pretty meaningful moves. And so when you really get into the inflation, the growth outlook that we have projected for next year, we show that on slide 6 in yesterday's deck. That you're really not worried about a 1 sigma delta until you get into kind of March, April timeframe. And so that to me is kind of where I think a lot of we've been talking about this for months. I think a lot of the market risk is concentrated in that particular time frame, not just because the growth delta start to pick up to the downside, but it's also when the flattening of the net liquidity curve should really start to occur in a way that could kind of perpetuate some more market volatility. We showed that slide on slide 107 in yesterday's deck. And then lastly, Brijesh, I'm sorry if I'm mispronouncing your name, but thanks for joining us. So given the deflation regime we might be in a low yield environment, how is the Nasdaq expected to perform? What are the advantages and risks for Nasdaq? So you don't want to be long the Nasdaq when you're in a deflation regime, generally speaking, unless you're talking about a modest deflation with respect to growth and or inflation. But once inflation starts to pick up to the downside, once growth starts to pick up to the downside, as our great asset market backtest analysis shows, you typically don't want to be long, those kind of tech oriented type exposures. And the reason for that is I don't think it's fundamental. I just think that in terms of how the market works, or the kind of process to getting to a market drawdown, is that investors really start to concentrate their growth in the exposures that they know can grow, and kind of by the time growth really starts to slow down and kind of impacts those companies as well, that's when you start to see the broad de-risking in the buy side, the broad de-risking from retail investors, and the actual kind of heading for the exits and raising for cash. So hopefully our process is kind of will help us avoid feeling the brunt of that process by getting out in front of it, as we did several weeks ago with some of the pivots we made in early November. But with that, Andreas, any parting thoughts, my friend?
No, it's going to be an interesting time and much more difficult than 2021.
Absolutely. Yeah, definitely. And then my parting thought would be not every, you should not, again, as I said at the very beginning of today's talk, not every market environment is particularly if you're a retail investor. Obviously, if you're an institutional investor, you can check out when I say this because you got to remain fully invested. But to the extent you don't have to remain fully invested, why are you fully invested in a more challenging regime? And that's exactly what we talked about in today's lead off morning note. Hey, you're just dealing with the higher volatility market. You're dealing with a market that may not have trending sector and style factor leadership that makes it easy to not only establish positions but also maintain the positions to continue buying the dips in positions. It's just not an easy market to trade, and I think a lot of what we've seen from a volatility perspective may not start to trend from this particular point, but I think we've seen enough previews of what it might look like at some point in the first half of next year. So we want to be well out in front of that and having these discussions today, as opposed to having those discussions with vol as well north of 30 in terms of the VIX. So with that, thank you guys for joining us. Thanks, guys and gals. Andreas piping in from Germany, man. Appreciate you guys. I appreciate
Thank
everyone in
you.
Global Team 42. You guys are a wonderful community, and I look forward to catching up with you guys next week. Cheers.
All right.